Stock Daily Insights. Your daily market canvas.
Let's dive into the latest updates and analysis on the fundamentals before we break down the market indices and top-performing stocks. NVIDIA, pioneering the future of data centers, and CEO Jensen Huang, CEO of NVIDIA, is shaping the future of data centers and AI technology. He discussed a $1 trillion investment aimed at modernizing general-purpose data centers to accelerate computing power. Driven largely by generative AI, Huang highlighted that generative AI isn't just a tool but a skill set, driving rapid growth in the data center market and giving rise to new industries like digital assembly line workers and chatbot developers. Optimizing data centers. NVIDIA plans to condense large data centers into smaller, more efficient spaces. Their new Blackwell chip system is already in production, with shipments expected in Q4. The company is preparing to scale production to meet the overwhelming market demand. Boosting productivity with AI. Huang emphasized that AI is dramatically improving productivity. Within NVIDIA, code generators are widely used to reduce the need for software engineers to write code manually. Diversifying the supply chain to ease concerns over Asian supply chain dependencies, Huang confirmed that NVIDIA's design is diversified, and the company can shift production between different foundries to ensure stable supply. Market reaction. Huang's optimistic outlook gave NVIDIA's stock a boost, closing Wednesday on a high and lifting major stock indices along with it. Year to date, NVIDIA's stock has surged 136%, and over the past 12 months, it has nearly quintupled with a 500% increase. Mid-cap stocks, poised for growth in the rate cut cycle. Goldman Sachs is betting on mid-cap stocks to outperform as we enter a rate cut cycle. Their analysts predict that after the Fed begins lowering rates, mid-cap companies, those between small and large caps, could see explosive growth. Historically, mid-cap stocks have outperformed both small and large-cap stocks in the 12 months following the Fed's initial rate cut. Rate cut expectations. Goldman expects the Federal Reserve to cut rates by 25 basis points next week, followed by similar cuts in November and December. Projected returns. Analysts at Goldman project that mid-cap stocks could deliver a 13% return next year, driven by lower initial valuations and a healthy growth environment. Valuation and quality edge. Mid-cap stocks offer a blend of growth and quality at a discount compared to large caps, which are trading near all-time highs, with an expected annual earnings growth rate of 11%. Mid-caps outperform the 7% average growth expected from S&P 500 constituents, and they have stronger balance sheets and profitability than small caps. Economic impact. Goldman points out that fast-paced economic expansion will push mid-cap stocks to deliver the strongest monthly returns. Even with a slowdown, mid-caps tend to show solid monthly gains. Risks and buffers. Weakening employment data could pose risks to mid-caps, but their lower valuations, strong fundamentals, and a low probability of recession next year provide a safety net. Small caps struggling. Goldman believes small caps, being more sensitive to economic fluctuations, may struggle to outperform in the current market environment compared to mid and large cap stocks. Global EV sales surge in China, slump in Europe. In August, global electric vehicle sales grew 20% year over year, with 1.47 million units sold, largely driven by China's booming market. China hits record highs. China set a new record in August, with EV sales surging 42%, surpassing the 1 million mark. Europe's struggles. In contrast, Europe's EV sales dropped by 33%, the lowest level since January 2023, largely due to Germany slashing subsidies, which caused sales to drop 23%. Year-end forecasts. Market analysts predict China's EV sales will rise by one-third this year, reaching 10.5 million units, while Europe is expected to maintain flat sales, around 3.1 million units. Demand slowdown and manufacturer adjustments. After several years of explosive growth, EV demand is cooling, with consumers either waiting for more affordable models or opting for hybrids. This slowdown has forced several automakers to scale back their electrification plans. North America's steady growth. In the US and Canada, EV sales grew 8% in August, reaching 160,000 units, showing steady growth in the region. Buffett's big bet on Occidental faces trouble as oil prices fall. Warren Buffett's heavy investment in Occidental Petroleum is facing challenges as oil prices continue to slide, putting his massive stock holdings at risk. Berkshire Hathaway's stake in Occidental. Berkshire Hathaway owns 255 million shares in Occidental, making it one of the company's largest equity investments, accounting for 28% of Occidental's outstanding shares. It's the sixth largest holding in Berkshire's portfolio. Investment losses. Occidental's stock price has fallen by 15%, dropping below Berkshire's average cost of $54 per share, pushing the investment into the red. Preferred shares and warrants. Berkshire also holds $8.5 billion in preferred shares, which yield 8% annually. However, 84 million stock warrants with an exercise price of $60 per share are currently out of the money. Buying halted. Berkshire paused its purchase of Occidental shares in June. The company's weak performance is attributed to falling oil prices, which have made energy stocks less attractive, coupled with Occidental's heavy financial leverage, limiting its ability to return capital to shareholders like industry giants. Occidental's strengths. Despite these issues, Occidental remains a significant player in the energy sector, with extensive chemical and pipeline businesses, and is the largest oil producer in the Permian Basin in Texas. That's it for today's insights. If you found this valuable, be sure to subscribe and share your thoughts in the comments. Let's take a look at the pre-market performance today. After yesterday's CPI data and Jensen Huang's remarks, particularly with a strong bullish close, we're seeing a slightly upward movement in the Asian and European sessions, indicating a weakening sentiment among the bears. Looking at the market's recent expectations, there are two scenarios. One is whether the current rebound can sustain, and the other is whether the recovery will falter and create new lows. I personally outlined a consolidating triangle pattern, indicating some indecision and back and forth movements. Yesterday's technical analysis had some speculative elements, as we couldn't predict how the data and Jensen Huang's comments would impact the market. In hindsight, it seems that the consolidation triangle was indeed effective, right? Both bulls and bears should now readjust their expectations and prepare for further upward movement. Now, we need to observe whether bulls can continue to push prices higher. We've drawn a new steeper upward trend line to follow the recent trend. Are we sure the market will go up? We can't be 100% certain, but it does feel like the odds of an upward move are higher. Could the market pull back before the rate cut, or could it turn bearish after the cut is announced? We can't say for sure. That's the inherent uncertainty in the market. Our focus should be on marking out local trend lines and monitoring any bear reversals. Unless bears make a strong move, we should lean towards a bullish outlook. If this is indeed a double bottom forming, bulls should not be afraid of going long at these levels, which are relatively low. If this is truly a double bottom, what we're seeing is just confirmation of the dip. In the last 2 trading days, there's been some hesitation, so it wasn't a very strong move yet. If a large bearish candle forms soon, don't overanalyze every little fluctuation in the candlesticks. Trying to be too precise can actually make things more difficult. Sometimes, it's better to keep things a bit more flexible. Looking at the hourly chart pre-market, there haven't been any strong bearish signals yet. Could they still come later today? It's possible. After the US markets open, there might be a slight pullback. The consolidation triangle pattern could lead to more oscillation, and we can't rule out further efforts by the bears. However, for bears to make a move, we'll need to see significant bearish candles. Without those, the bulls can continue holding or adding to their positions. Are these lines set in stone? Not necessarily. Yesterday I considered deleting some lines, but then decided to keep them. The consolidating triangle is still relevant, and it's possible we'll see more oscillation ahead of the rate cuts, which are significant enough to trigger potential reversals. But unless that happens, we'll continue approaching the market from a bullish perspective. How high could this go? The sky's the limit with the US stock market, right? But what if it dips? If we see a bearish move, a drop to the 7-day moving average could signal a place to reduce positions or exit. We also have a steeper, more localized trend channel that we can monitor. It's essential to have stops in place, otherwise, you could get shaken out by minor moves and miss the bigger trend. Now, let's check small caps. Small caps are likely playing a range-bound bullish game right now, with lots of oscillation. These are good for traders who like playing small waves. The Dow shows a similar pattern. Yesterday's candlestick was quite complex, with a strong dip followed by a rebound. So, the play is to go long again and aim for a test of the recent highs. The strategy here is more focused on trading in short bursts within a range where big waves are rarer. As for the S&P 500, it's holding for now and might be a good candidate for going long. Yesterday's potential bearish scenario was avoided with a bullish close, so we should quickly switch back to a bullish stance. When the market changes direction, you need to adapt quickly. If you cling to a single narrative, you'll miss out. The market has 2 directions, and your success depends on how quickly you can pivot to the other one when needed. Now, let's go through some popular stocks, starting with blockchain. Take IOT for example. If you're bullish, You'll need to wait for clearer entry signals because the right side point hasn't materialized yet. To wrap up, we're still in a general upward movement, but be prepared for volatility as we approach the rate cuts. Make sure you have your stop losses in place, and don't get shaken out by minor fluctuations. For now, it's still time to stay bullish unless we get a clear reversal signal from the bears. Let's take a closer look at Disney. Yesterday's candlestick had a pretty good visual effect, showing a slight dip of 0.09%. If you compare this candlestick to the Dow's chart, you'll notice a similar pattern, right? It dipped, but then bounced back up, signaling that the bears might not be as committed to pushing the stock down. This bounce suggests that the bearish sentiment is weakening. If we get another strong bullish candlestick today, that could signal a double bottom forming. We can even hope together. Come on, give us that big bullish candlestick. If it does appear, it could present a prime buying opportunity. For now, let's stick to the probabilities based on past experiences, which tend to favor this type of setup. Now, let's move on to PLTR. People are asking if they can still buy PLTR at this level. Well, yes, you can still go long. Just adjust your trend line accordingly. Yesterday, the stock opened with a gap down, but then rallied throughout the day. There's no upper shadow on yesterday's candlestick, which indicates that the bulls were persistent. So, for now, I'd maintain a bullish outlook for PLTR. We've been following PLTR since its IPO. I'm sure you all remember. It's been a wild ride, with lots of ups and downs. We even considered it a good stock for bottom fishing last year or the year before, but the chart has been extremely volatile. Looking at Tesla, yesterday's candlestick saw a quick shift in sentiment. Even though the stock had a major bearish candlestick earlier, the bulls seem to be coming back. The market can be complicated like that sometimes. Yes, we can't ignore that big bearish candlestick, but the bulls have started to regain control, so it's time to reconsider going long. The bears haven't been able to maintain momentum. If yesterday had closed in the red, things could have looked pretty bad, and we'd be retesting lower levels. But with a V-shaped recovery, it's a signal to pivot back to a bullish stance. Why all the back and forth? It's because Tesla is currently stuck in a narrow, sideways range with no clear direction. It could go either way. If you look at the weekly chart, it's still in a sideways consolidation, meaning it can either break upwards or downwards. But for now, it's chosen to break upwards, so let's stick with the bulls. I've drawn a new trend line to track this move. As for Apple, yesterday's candlestick also closed bullish, which suggests that this was likely just a small pullback. We were never overly bearish on Apple anyway, so the strategy here is still to go long, and you can adjust your trend lines accordingly. If it dips again, we might see some consolidation, but after a rally, it's perfectly fine to pause for a bit before moving higher. Next, Google. In theory, you could attempt a left side entry now, but it's safer to wait for confirmation and add more on the right side breakout. Let's check in on Dell. Dell's chart is showing signs of an upward breakout. If you're interested in this one, you could adjust your trend line and look for an entry, or skip it if there are better setups elsewhere. Next up is Eli Lilly. This stock also saw a pullback. While yesterday's candlestick was bullish, it was just one day of gains, so we might see a bit more consolidation. Its recent pattern is quite similar to Apple's. Let's see if we get another bounce here, just like in previous consolidations. Amazon has finally made its move upwards. We mentioned earlier that the bulls needed to step up, and they have. Now, it's time to keep going long. Some might say it would have been better not to sell earlier, but that depends on how you see it. Your portfolio will always have some deep pullbacks, especially with big tech names like Google, Micron, Mu, Supermicro, SMCI, and ASML. There's always a 50% chance of a deeper pullback with these heavyweights, so you can't expect your entire portfolio to only experience shallow dips. AMD is one of those deeper pullback stocks, but it's still a long play. T3Q is another example. It hasn't broken support, so we should look to go long. During our live stream, we drew a stop loss level, and it looks like going long was the right call. ASML also saw a deeper dip, so it's time to start building a position and wait for a right side breakout. ASML is also in a 5-wave pattern, so we're keeping an eye on that. Broadcom, a VGO, could also be bottoming out soon. Now, let's circle back to NVIDIA. For now, NVIDIA is looking bullish with a strong candlestick suggesting more gains ahead. SMCI is also in a deeper pullback, so build a small position and wait for the right side confirmation. Finally, the semiconductor sector overall is in need of a big bullish candlestick to boost investor confidence. Did we get one yet? Today, we need to watch Disney closely and see if it delivers a similar strong move, just like the semis. If we do get that bullish candlestick, more bottom fishing opportunities will arise. As always, focus on trading in waves. The US Stock market is complex. If you're holding onto stocks long term, sometimes you won't see immediate gains. That's it for today.
Stock Daily Insights. Your daily market compass.